I think what can go wrong is really the long term. I mean, at the moment, we have this sort of euphoria based on a vaccine, and we've had this sort of cyclical rally and value rally. But ultimately, we're going to settle down into a post-COVID world at some point in late 2021, which is going to look like 2019, except a little bit worse. So we've got all the same old problems. We've got demographics, we've got shrinking workforces, we've got inequality, we've got a massive debt overhang, which is going to weigh heavily on aggregate demand. And we basically we have a world of 2019 except worse. So that's going to be pretty tough. At the moment, though, the market is in the transition phase from kind of restriction misery, which we're going through at the moment, which hopefully will end at some point in March or April. Then we transition to the recovery, which is what's being priced ahead now. And then back to stagnation afterwards. So we've got these three sort of time horizons that the market is grappling with. And right now, the market's happy to focus on the medium term, which is the vaccine recovery.
So how do you play this? Because, I mean, if your analysis is correct, we've possibly got a couple of quarters of growth and inflation and a rotation that continues into small cap cyclicals, beta to the market. Do you engage and try and squeeze as much out of the tea bag as you can at this point, or do you just accept that the longer term future is more difficult and continue to take advantage of perhaps cheaper defensives?
I think it's quite hard to sort of try and engage in the short term because obviously it demands a degree of market timing. But also, if you look at the market behavior over the month of November, you could say, oh, well, it's been a value month and look at value versus growth and look at Europe over the US. But on the other hand, there have been days when technology actually has done pretty well. So if the data starts to sink, tech starts to outperform. So I think as an investment manager, I think it's much better to invest for the long run and strategically, and then just try and play tactically, if possible, around value. But recognizing that is extremely difficult, if not impossible. But the long-term reality is going to be very, very low interest rates. That keeps asset prices high. And in addition, it's going to boost net present values of companies with high levels of intangible assets, which points to the technology, which sounds kind of a bit old-fashioned now. Have the technology rally having run out at the end of August. But I think there isn't much alternative if you look at the sort of fundamental basics of the world economy stretching out over the next 5 to 10 years.